Hello everyone, welcome to the channel of Qianmo. We've introduced the trust in our last video. In this video, we will talk a little bit about company. Also a very common applied rule called Div7A. We all have heard about companies. They are everywhere around us. Some of us may even have purchased the shares of some listed companies. What do you think is the most distinguished feature of a company? I believe it would be that a company business structure is a separate legal entity, unlike a sole trader or other partnership structure which are not. What does this mean? This means the company has the same rights as a natural person and can incur debt, sue, and be sued. As a shareholder, you are not liable in your capacity as a shareholder for the company's debts. It is immeasurable how much this design has freed the setting up and operating of businesses. Imagine if you'd be personally liable for any debt it may occur in the course of running a business. That way, people would be extremely cautious before they decide to start and create or even invest in a business. With the feature of being a separate legal entity that a company is endowed. As a shareholder, you would only expect to lose all the money you put into the business should the business falls down. As time goes on, hopefully the businesses make profits. In ordinary cases, a shareholder would receive the profits via a few ways. First, of course, receives dividends when the company decides to declare the dividends to the shareholders rather than letting the earnings stay in the company. Sometimes, the company may decide to reinvest the earnings in the company for further expansion of the business. So, companies may not declare dividends every year. Second, like many investors in the stock markets, people may sell the shares if they are worth a fortune. Thirdly, in some small businesses, the shareholder him or herself holds the most important role in the company and serves the position of the CEO or the director. At the time when the company doesn't make money yet, they may be receiving very minimal wages. However, as the company grows larger and start to have sufficient cash flow, they would expect to receive wages that matches the market level as a director or CEO. But over time, it also becomes often, especially in small businesses, that the shareholders take out some money from the company. However, instead of being dividends declared or as wages that they are entitled to receive, they simply record it as a loan. Since it's their business, normally they would not return that loan back, nor pay any interest to the company for that loan. Now, let's think about what differences does it make. Well, first of all, as we've mentioned previously, company is a separate legal entity that eliminates the shareholder's liability to a limited level. However, in the meantime, the shareholder also should not just take out the money from the company for no reason. Let's have a look from the tax point of view. If the shareholder receives dividends from the company, as a shareholder at personal level, you are supposed to be paying tax on the dividend. If the shareholders sell the shares, that would be under the capital gain tax. And if the shareholder holds the position as a director and receives wages, that wages are accessible ordinary income. But without declaring any of the above, the shareholder does not pay any tax on the amount of money taken out from the company. So that is not fair. Therefore, here comes Div7A. Div7A is part of the Income Tax Assessment Act 1936 and is intended to prevent profits or assets being provided to the shareholders or the associates tax-free. So, what does Div7A say? Well, Div7A is a very detailed act. In this video, we would just introduce in a very simple nutshell. Under Div7A, a payment or other benefit provided by a private company to a shareholder or their associates can be treated as an unfranked dividend for income tax purposes under Div7A, even if the participants treat it as a form of loan, gift, or writing off a debt. So that means the shareholder would need to declare this payment as unfranked dividend in his or her income tax return. So you can see that it would be much better to just declare the dividends, as if the company has franking credits, the dividends would be franked. However, also under the Division 7A, the shareholder doesn't need to declare the unfranked dividends if he or she enters into a real commercial loan with the company, which means the shareholder borrows money as part of a complying loan agreement and repay the interest and repayments every year according to the complying loan agreement. Okay, that's all for this video. This topic probably is the most difficult one in this whole series. I hope I haven't lost you yet. As an accountant working in accounting firms, we would need to know Division 7A very well. I hope this series of the videos would be helpful for you if you are starting your career in accounting firms. In the last, I hope you enjoy your work and have a great career ahead.